Hello, everybody. This is Chris Smith from TheOptionClub.com. I am here right now with Stan Freifeld from McMillan Analysis Corporation. Stan, this is his first time talking to us. He's going to be talking to us about the concept of buying options versus selling options and whether there's an inherent benefit of doing one versus the other. Stan, if I got your bio right, you are a veteran from the option pits in New York on the American Stock Exchange.
Exactly right.
And you are now heading up the mentoring program over at McMillan Analysis.
That's correct as well.
Okay. So rather than wasting time having me talk, I am going to make you the...
That's never a waste, Chris.
Well, I appreciate that. And you should have the ability now to share a screen. There you go. I can see it. And
okay.
I am going to turn it all over to you, and I'll just sit back and enjoy myself.
Sounds good, Chris. Thank you for the introduction. Okay. Well, I want to thank everybody for coming to this webinar. Like Chris said, it's the first one that I'm doing for the Option Club. I do a number of them at McMillan Analysis. I'm really looking forward to this. I know it's a good group. I've been a member of the club myself for some time, and I think it's great that a lot of people are out there willing to listen to me talk about options and the difference between buying them and selling them, because I know a lot of people have a preconceived notion that one is better than the other. So we'll get into a bunch of things like that. I want to say that Chris is going to help me out and answer questions if they come in. So if you're sending in questions, Chris will answer them, or if they're very particular to something I'm saying, he'll shoot them over to me, and I'll give it a stab as well. All right, well, let me get started. It's a little bit after 9. I have a lot of material that I want to cover here. Let's see if this works. Yeah, okay. First, just a quick outline of the presentation. I always started out with a who am I, and I don't mean that in the metaphysical sense, but I'll give you a little bit of history so you'll know where I come from and have some information about me. I'll also give you some background information that we need to examine some of these reasons. So it's relatively basic, and I think most of what I'm going to talk about is relatively basic. I do some very advanced training as well, but tonight we're going to talk about this particular topic. So I'll list out the reasons why some people feel it's better to sell than to buy, and we'll talk about them. I'll give you some final thoughts, and then MAC, that stands for McMillan Analysis Corporation. We have some specials for people who are attending, and I'll show you what they are. If you know McMillan Analysis and you know me, there's never any pressure to do anything, but at least we'll let you know what they are, and if you want to partake, that would be great. If not, that's that'll be okay as well. Here's a picture of me so you could get a feel for who you're talking to, or who you're listening to, I guess. I was an actuary for 20 years. I owned a pension consulting company, or I was a part owner, to be honest. And I sold it to a British firm that kind of overpaid a little bit. I didn't have to work for a couple of years, and figured, what could I do where I could use my mathematical ability and also, at least in my mind, have an unlimited top end. Plus, I figured if I went to trade on the floor of an exchange, I couldn't work weekends, even if I wanted to. The market's closed. Can't work. Can't work overtime, not too much anyway, and you can't come in early. There's a little bit of paperwork, but basically, this was really, at that time I had little kids. It made a lot of sense to me, and it met my mathematical expectations, because as probably most of you know, there's a lot of mathematics in options trading. You don't have to be a mathematician to trade options, but some of the concepts do involve mathematics, and you could get involved to varying degrees. Anyway, I went from being an actuary, I went to the floor of the American Stock Exchange. I said, I want to trade options. They said, do you have a clearing firm? I said, what's that? They said, who's your sponsor? I said, oh, I need a sponsor. I knew very little, but eventually got past all of that stuff. This was back in 1994. I sold the company in 93, went on in 94. And eventually, I was just trading my own money. Trading, a guy trading his own money is referred to as a local, as opposed to standing next to somebody from, let's say, a Merrill Lynch or one of the big firms where they have relatively unlimited capital. But I did very well. I became an official of the floor, and then I stayed on the floor actually through 9/11. At 9/11, as an official, I knew just about everybody, and 7 guys were actually killed from the Amex. I left, and truth of the matter is I was planning to leave anyway. I wasn't planning to leave that day, though. And a couple of years ago, I guess about, now it's 6 years, time has flown by, I hooked up with Larry McMillan, who I knew of. I didn't know him personally. I gave him a call, said, would you be interested in setting up a mentoring program with me? And he said, sure, well, let's do it. And here we are, 6 years later, doing the mentoring program, and I trade when I'm not mentoring. Okay, that's me. All right. Anyway, let's get into the the real presentation. I said there was some background information that I think would be necessary, and that's there are really 6 basic positions of for an options trade, right? I didn't include long call, short call, because we're really we're only looking at the options side of it. So when you're buying something, and we say we're long when we buy something. I remember in Mnemonic, they said it belongs to you. So for those who have trouble remembering what long means. But anyway, if you're long an option, you have a limited loss. There's only a certain amount you could lose, and that's what you paid for that option. On the other hand, there's unlimited gain. Now, of course, on the upside, it really is unlimited. I love it when people say the stock could go to infinity. Aside from Berkshire, I don't think I've seen any that have. Well, maybe Apple's on its way. Who knows? But on the put side, I mean, the truth of the matter is, the stock could only go to 0. So there is, it's really not totally unlimited. But we consider if a stock, a significant stock gets close to 0, that's pretty much of an unlimited gain for you. You'd be a pretty happy camper, I'd say. Actually, a couple of years ago in 08, it seemed like some stocks did go to less than 0, but in reality, they can't do that. So the basic characteristics of buying an option, which is what's going on up here, is that there's only a certain amount we could lose and an unlimited amount we could make. On the other hand, short positions, they're kind of mirror images, as you could see. If we flip it over along a horizontal axis, we'd go from long to short, and the difference in the characteristics are that short positions have a limited amount that you could gain, and basically when you sell an option for X dollars, that's the most you could make, X dollars. On the other hand, the loss is unlimited. And again, it's really unlimited on the call. On the put side, your maximum loss would be when the stock goes down to, or the underlying. I'm going to talk in terms of stock, so I don't have to keep saying underlying. But when the stock goes down to 0, okay? So that's kind of what we need to know. And now we'll get into the. I'm going to give you 5 reasons, but it's commonly written and common to hear that it's better to be an option seller than a buyer. I'm sure, if I had you in a class, I'd say, all right, raise your hands if you've heard that. And I'm sure most people have. Now, I'm one who doesn't really believe that, and I'm going to try and prove it to you as well. I'm not saying it's better to be a buyer either. I'm saying there are times when it's right to be a buyer, and there are times when it's right to be a seller. Okay? So under some market conditions, selling could be very profitable. Other times, it could lead to disaster. And even a lot of professionals that I know, most of my friends are traders and guys from the floor. We've all had situations where we might have oversold a little bit and ran into some trouble. The good news is that we, as professionals, we kind of know how to get out of that trouble. Sometimes public traders have a little more difficulty when they do run into problems. Anyway, what I'm going to do tonight, I have 5 of the top reasons that are usually given for being a seller as opposed to a buyer. And what I'm going to do, I'll put each of them up, and we'll go through each of them. I'll give you my thoughts on it. And we'll see if I could get people to agree that we don't really know which is better, buying or selling. It depends on the environment at the time. Okay, so we'll go through 5 of them, and I'll describe each one. The first one that you probably have heard is that options decay, and time is always moving forward. Ka-ching, right? You have to make money. Time is moving forward. Time can't go backwards. Actually, Einstein might argue with that, but I guess I'm not Einstein, so I won't try and argue that point. But seriously, the truth of the matter is time does go in one direction, and I'll grant that. Yes, time decay benefits option sellers. There's no doubt about that in my mind. And yes, time is also always moving forward. It's always moving forward. You can't go backwards in time. Okay, fair enough. But that's not the only thing that impacts on an option price, right? You have stock prices, you have implied volatility, and they move as well. And sometimes, right now, I guess we're not too worried about interest rates, but otherwise we'd have interest rates to be concerned about in addition to stock prices and implied volatility. And I mean, here's the thing. I mean, do you think that the buyers don't know about 1 and 2? You say, gee, I know something. I guess the other guys don't know this. They don't know that time decay only benefits option sellers, and that time is always moving forward. Well, guess what? The buyers know that too, but there are reasons why they think there are reasons that might outweigh, and it might be perhaps number 3, that outweigh 1 and 2 at certain times. So that would be my argument against the time is on my side argument. All right. Number 2. Some of these will be short, like that first one. Some will take a little bit more time to cover. Casinos sell bets, and they've built some pretty nice hotels. The implication being that by selling, the casinos have done better than if the casinos were buying bets. Well, let's take a look at what it means to buy or sell a bet to begin with, and see how that relates to options. We'll look at a game, the game of roulette, and it's interesting. I know I'm out in New Jersey now, where it's 9 o'clock. I know the Option Club, I guess, is headquartered in Las Vegas. So me explaining roulette table to a lot of the people there is probably preaching to the choir, so to speak. You're probably at least as familiar with this as I am. But for those who aren't aware, a roulette table looks kind of like this. I think this is a decent picture. It has numbers from 1 to 36, a 0 and a double 0. So we have 36 numbers, 2 more, a total of 38. And the way it works, well, there are different types of bets you could make, but you bet on a particular number, and if you win, they pay you 35 to 1, $35 for every $1 you bet, or units, 35 units for every 1 unit you put up. There are also, you can see on the table, 18 of the numbers are red and 18 are black. The 0, I guess, over here, and the double 0 over here, they're green. And so you could bet on red or black or low numbers or high numbers. There's lots of different bets that you could make that are basically pretty even. They're the payoff is even. They're 1 to 1. And then in addition to that, there are other bets available as well, but the concept's going to be the same. And People think of it as the casino is selling the bet and the player is buying the bet because the player is putting up the money. You know, you go, there'll be a table laid out, and you might put $1 or $5, or if you're me, maybe 50 cents on a particular number, or well, let's say we pick a number. Okay, so I'm going to put some money on a particular number. They spin it, and I either win or lose based on that. Now, we have to understand the concept of mathematical expectation. It's well, it's actually it's kind of interesting. It's easy to apply in the case of roulette. Sometimes when we're talking about options trading, it's not so easy to apply. But the concept of and the definition of mathematical expectation is pretty straightforward. Okay, mathematical expectation is equal to the sum of all the wins and losses multiplied by their probability of occurring. All right. So what I'm going to do here is I'm going to look at it from the player's point of view and the casino's point of view. Right? I'm going to take the probability of winning, which for the player is 1 out of 38. There are 38 numbers. I'm betting on one of them. So my probability of winning, assuming the table is legit, is going to be 1 out of 38. My winning payoff is $35. Well, we're talking dollars instead of units. And to that, I'm going to add the probability of losing. I guess I mean losing over here, which is 37 over 38. Most of the time I'm going to lose. I'm going to lose that $1. So if you multiply this together and you multiply this together and you add them both up, you're going to see there's a negative expectation of 5.26%. From the casino's perspective, it's just the opposite, right? Their probability of winning is going to be, they're going to win 37 out of 38 times. They're only going to win the $1, but they're going to lose 1 out of every 38 times, and they're going to have to pay out $35. Again, you put this all, you multiply and you add, and you see the casino has a positive 5.26% expectation. Well, what's the cycle of the player? Well, what's his win-loss cycle going to look like? He's going to basically, he's only going to win 1 out of 38 times roughly. So it's going to be, I don't want to put 38 little L's, but it's going to be lose, lose, lose. He's going to lose a lot, and then he's going to have this big win. He's going to lose $1, lose $1, lose $1, win $35, lose $1, lose $1, lose. And that's his cycle. Okay, that's the cycle of the buyer in this case. What about the casino? Well, the casinos, their cash flow and their life is going to be kind of the opposite here. They're going to win most of the time. Yeah, it's very nice. I win, I win, I win. But when you lose real big. That's how like somebody's selling options maybe, or deep out of the money puts perhaps. I don't know. But anyway, so that's the difference in what the life cycle is going to look like. But is that really, is that going to be important? Well, I think the answer is no. It might impact how you feel about the types of positions that you're putting on or the types of bets that you're making. Some people don't like losing all the time or most of the time and then having an occasional big win. Some people feel better winning most of the time and then, every once in a while giving back some of their gains. But let's take a look. We said the payoff was 35 to 1, right? What if the payoff was really 37 to 1? Then the game would be fair. And what I'm telling you, we go through the calculation, we see it's 0%. This would be for the player. The same thing would be for the casino. And what I'm telling you is that if this were the case, if they did pay 37 to 1, it would be an even game. The life cycles would be the same, just like this. But it would, you'd still lose, and you'd lose most of the time, and occasionally you'd win big. But overall, you would expect at least to come out even. Now, well, this, I say laugh out loud. It's kind of, something like this could never happen. Actually, even the 37 to 1 is never going to happen. But if they paid out 38 to 1, let's say in my dreamland, the player's expectation in that case, now it's going to be positive. Okay, so in this case, even though I'm the player, is going to have this cycle of losing, losing, and just occasionally winning, the player, or the buyer in this case, would now have the advantage. Now, I don't know if this is resonating yet to you as to how we're going to look at option trading. What's roulette have to do with that? Well, we see that basically it's not whether we're winning or losing, how many times we're winning or losing. I think what's important here is the fact that we have a positive expectation in this case, in the 38 to 1, whereas in the 35 to 1, we have a negative expectation. So here, this is really the explanation. The player in the original game is playing a game that's stacked against him, but it's not because he's a buyer. Okay, it's really because of this negative expectation, that negative 5.25%. Over the long run, he's not going to win. He'll have maybe some people will play roulette and they'll go home and they'll win, but there's no way to overcome that negative expectation. In fact, I was teaching a class and we were talking about it, about expectation, and somebody told me that he had a system that's going to win at roulette. And I said, all right, well, why don't you tell me about it? I'll put it on the board. And he said, well, no, I can't tell you about it. I paid too much money for it. And okay, I hope it pays for itself, you know. But there are, you know, you can't win mathematically a game like roulette. And by the way, the table that I showed you that had the two greens, the 36 numbers from 1 to 36, and the two greens, there are tables. I don't think there are many in the U.S., but outside of the country, some have only one green slot, and so the expectation against you is it's half of the 526. So what would that be? 263 or something like that. Okay. Anyway, to make roulette a fair game, the payoff has to be 37 to 1, which I showed you before, not the 35 to 1. Or we could look at it a different way. If the payoff was going to be 35 to 1, then we're overpaying for the bet. In other words, we really, if we're going to get $35, we should only be paying 95 cents, 94 and a change, 94 3/4 cents for the bet to get back $35. That again would make it a fair game. Okay, so these two really are equivalent if you if you think about that. So the bottom line here is it's not the fact that the player is the buyer; it's the negative expectation, and that's the same thing when you're trading. At least the way I see things. All right. Here's one I could really talk to because I was a market maker. In fact, I was an official on the floor. So I kind of know a little bit about being a market maker. Market makers sell options, and they are the smart money. Well, let's analyze that one. Is it true that market makers sell options generally? Well, okay, I'm going to say yes. But why is that? It's true market makers generally do sell more than they buy. Generally, that's true. Why is that? It's because market makers are reactive to public order flow. If I decided that I wanted to buy an option, I used to trade DuPont and Shearing Plow, Walgreens, but I'm standing in the DuPont crowd, and I say, I want to buy options on DuPont. I want to buy calls or puts, doesn't matter. Who do I buy them from? I can't just go out and buy these options unless I want to pay up. Now remember, as a market maker, I want to buy on the bid and sell on the offer. If I want to buy options, and most of the paper coming in or public order flow is buying, it makes me a seller. I don't have anyone to buy. Am I going to buy from the market maker standing next to me? He's going to want a premium for to give me that privilege. So since most of the public order flow is on the buy side, market makers are naturally sellers. Okay, and a lot of people don't realize that a market maker doesn't have as much leeway as you may think. In other words, as a market maker, I had to make markets on all the options that traded in DuPont as an example. You know, some guys don't like to, guys on the floor, they don't like to trade leaps. Why not? Because the public is only going to buy leaps. It's very rare that you see the public selling leaps options. You know, because the decay is so small from day to day, and most of the time, I think public customers tend to use leaps as stock replacement, perhaps, or something like that. So market makers tend to end up with a large inventory of short options, and short leaps options. Now, of course, so what if the market maker knows that he's going to be selling? What does he do? Well, he raises the price of his offer, right? He's saying, I'll buy him a little higher because I know nobody's going to sell them to me. On the other hand, if you want to buy them, you're going to have to pay up now. So, but anyway, it gets to a point the market maker has so many short leaps options, they say, I don't want to trade these anymore. But you can't really do that. You know, part of the rules, at least when I was there, you know, like I said, I left on 9/11, and things have changed tremendously. So I can't be 100% sure anymore. But you had to make markets, whether you wanted to or not. So anyway, getting back to some market makers like trading from the short side. There's no question about that. And some had a bias of wanting to trade from the long side. But particularly the ones who like trading from the short side, those are the guys who are trading somebody else's money. In other words, I was trading my money. If I, you know, we had either steak or pasta every night. Good days we had steak, and other days we had pasta. I grew to like both, so it worked out well. But you know, I had mostly good days, but it was very important to me to preserve capital, whereas guys who were trading somebody else's money, they didn't have that same kind of worry. If they took a shot, so to speak, and it ended up working, well, what would happen? They'd get a very nice bonus. If it didn't work, what's the worst that could happen to them? They'd be fired, and then they'd go work for another company. Well, I have a lot of experience trading. I'm a good trader. Da-da-da-da-da. And you go somewhere else, and you start all over again. But when you're trading your own capital, it doesn't work like that. Anyway, the truth of the matter is, at least as far as I know it to be, most market makers always try to hedge their positions, whether they're long or short, and they're very aware of their short gamma positions. Okay, because with short gamma, you know, that means short options. You know, we're not going to talk about the Greeks tonight, really. But if you're short gamma, if you're short options, you probably have a very short gamma position, and you know, that could lead to some issues, I guess. And some people blow up. You know, they end up just running into trouble. You know, I've seen that happen. In fact, I've seen it happen on the floor. I've seen it happen off the floor as well, with guys who got too big, either selling puts or well, I shouldn't say this. There's probably a lot of people who sell iron condors, but selling iron condors and then just doing too big size that's too big for the size of their account and running into trouble. But you know, I guess you could run into trouble on any side, being a buyer or a seller. So we'll move on from there. Here's another one. Sellers have to be compensated because their risks are unlimited. Okay, now that makes a lot of sense, and you know, I basically agree with the concept here that we want to we want to be compensated if we're selling something. But let's take a look. What would I have to say about that? Well, let's take a look. From my perspective, the only way to really measure if you're being compensated or not being compensated is by determining if there's an edge. And how do we do that? Well, you calculate expectation and probability of the trade working. There's a number of things that could go into determining if there is an edge, but that's not what we're going to talk about now. But let's say there is an edge. Where do you think it comes from? In other words, it must be coming from the buyers, right? So I'm sure that if you ask a buyer if you think you have an edge, I'll bet the buyer, if you ask him, he'll think he has an edge. You know, why else would he be putting on why else would you be trading if you didn't think that there was an edge in your position to begin with, right? You're not going to put it on for what you think is fair value. So then it gets to the, you have to start thinking, gee, are sellers smarter than buyers? Do they know more about what's going on in the market? And, my answer to that is no. I think it's, it's pretty evenly, it's evenly matched. So, I don't take one side versus the other in this kind of thing. If there is an edge, though, and you think it's coming from the buyers, just be aware that overall, if we're just looking at options, forget about stock and options, because once you add stock into the equation, things change a little. But options just by themselves, just by definition, have to be a zero-sum game, right? So overall, money is just changing hands. It's not, no money is being created. Well, if one side has an edge, then the other side will have a negative edge, right? Or, but maybe they're not calculating it the same way. I mean, there's got to be some reason why there's a trade, and generally it's because both sides of the trade think that they have an edge. Does one really have one? Well, I would say it depends on the situation. Yes, sometimes the seller has an edge, and other times the buyer has an edge. It depends a lot on the particular situation and the strategy that you're using, and a number of other things. And then I said, I kind of just threw this in, and I said, do you drive a car? And what do I mean by that? Or I could have said, do you cross a street? Well, if we're saying that you have to be compensated for the unlimited amount of risk, and we're talking about financial risk, right? What about if you drive a car? Well, what kind of risk do you have in that case? Especially if you're out here by me in New Jersey, and I drive into New York from time to time. It's crazy out there. Although I guess you guys are pretty close to LA, a lot of you. So you know what crazy driving is all about. But to get from point A to point B, you could be, taking your health at least. You're risking your health, perhaps, or even, even worse. You could have an accident. Well, are you being compensated? Is it worth it just to get from A to B? You wanted to go out for a ride, or you have to get to work, or whatever it is. Is it worth it to take that chance? Well, it's the same thing with when you're selling options. I mean, yes, you're taking a risk. Well, let's say you just sell an option, you don't have any protection against it, which isn't always the best thing to do, but some people do that. You're taking a lot of risk, but you must think that it's worth it to get from from where you are financially now to where you want that trade to end up financially later on. Okay, so it's the same. I look at it the same kind of way that that we take unlimited risks, so to speak, all the time, whether it be with our trading or with our driving or with a lot of other things that you do with your life. You take these unlimited, quote, unlimited type risks. All right, and let's come to. Yeah, this was something interesting. I saw this today. I started thinking about it. So SPX today, it closed, I think this was the exact number, 1352.63. All right, there are 9 days left to go to March expiration. All right. The March 1350 puts are 1070 bid and offered at 1190, and the size was 25 by 171, meaning that if you wanted to buy it, you'd have to pay 1190. Assuming you wanted to buy it right away, you didn't want to buy midpoint pricing where you may or may not get filled. You wanted to get filled right away, you'd have to pay 1190. On the other hand, if you wanted to sell it, you'd get 1070. By the way, this is where this is how the market makers make their money, I guess, or at least in the past. This is how market makers made their money with large spreads like this. Nowadays, aside from SPX, the spreads on liquid options are much tighter, and it's much more difficult for the market makers. But SPX still has had problems with, but that's another story. Anyway, here's the question. Would you sell at 1070? All right? Now here's the information we have. 9 days to expiration. Stock's at 1350, not stock, SPX is at 1352. And we're looking at the 1350 puts. Well, let's say, I mean, how do you know where it makes sense to sell? Now, I'm not going to be talking about that today, but just the concept of if you're willing to sell for 1070, well, what if the bid was 1040? What if the bid was $9? In other words, where is the point at which you'd say, okay, I'm no longer a seller. At this point, I'm a buyer. If you could buy this for $1, would you be a buyer in that case? Well, I probably would, right? I don't know what's going to happen, but if I could buy this cheaper than what they're asking for, if I could buy it cheaper than the bid, it's without knowing anything else, without doing any calculations or knowing what the volatility is, I'd probably say, yeah, if I could buy it cheap for $2 or something like that, I'd be a buyer. But where would you sell? How far would you go? And the reason I'm asking you this is I was asked to for another club that I'm a member of, I was asked to take a look at a particular iron condor that was it was $10. Between the buy and the sell on either side, it was a $10 spread, and they were taking in less than $1 in total. I think it was 72 cents. So you had the probability, the possibility of keeping 72 cents, but the possibility of losing $9.28. And they asked me that. I said it wasn't a very good trade, but they came back to this group came back to me and said, well, did you consider? And they gave me all these things that they felt could, all the reasons why this stock probably wasn't going to move to either of the shorts within the time that we had. And the truth is I didn't go back to look how that trade did, but you had a bunch of people who were willing to sell at what I thought was much too cheap a price. And then I started asking these same kinds of questions. In other words, if you're willing to sell for 72 cents, well, because you don't think the event is going to happen. It's not going to go lower than the low strike, the low short, or higher than the high strike. Well, if that's not going to happen in your mind, then would you be willing to sell it for, instead of 72, would you sell it for 65 cents? Would you sell it for 60? Would you sell it for 50? And what I found interesting is that as a group, they couldn't come up with what they felt was a valid answer. So I'm just putting it in your minds that just because you can sell something and it looks like, well, where does where's SPX have to go to for this put to start losing money? We could do a subtraction and figure that out and say, all right, it's got to go down 10 this much plus the $2 from over here. There's quite a bit of leeway. What's that? A 1% move, something like that. Can that happen in 9 days? Well, the answer is yes, it can happen, and sometimes this might be a good sell, and other times it might not be. I also happened to notice when I was looking at SPX today that the March 1000. Think about that, right? The 1000 puts. This was really strange. They were a nickel bid by 10 cents, and there were like 243 or something like that bid, and maybe 1,150 offered, and an open interest of about 108,000 of these, and a significant number traded today. I'm thinking the only possible people that I could imagine who would be willing to pay a nickel would be people who are closing out this position. who would be willing to sell at a nickel the 1,000 puts? Then I'm thinking, well, look at it this way. If for the stock to get to 1,000, it's 13, or SP, I keep saying stock, to get from 1352 to 1,000, I figured that was about a 26% drop. What is the likelihood that that's going to happen within the next 9 days? It's got to be very small, right? Unless something really big happens. You know, I didn't go back to check how often moves like that happen, but I know that, you know, that doesn't happen very often. But is it worth selling anything for a nickel? And, you know, the bottom line answer, I think, is really no. You're just taking too much risk for not enough reward. And in fact, you know, just to further prove my point, some brokerage companies, I think it started with Thinkorswim, which was put together by option traders. Well, they will let you buy back. I'm not sure if they still do now. That's TD America. They probably do, but don't quote me. They will let you buy back your short nickel options, nickel or less, without paying any commission. And I've spoken to people there to see why do you do that. I kind of knew the answer. And it's because it's something that's very counterintuitive to want to do, but they've seen too many people run into trouble with it. So they give you they incentivize it by saying, okay, just no commissions, just do the right thing and buy back your nickel options. But there will be some people who will be selling these. Now, forget about the tremendous margin requirement. Forget about the fact that there's a commission coming out of this 5 cents to sell this guy. If this is what you're going to do, how many of these do you have to sell to make it worthwhile? You get $5 to sell one, right? Probably cost you a $10 ticket charge. So the first two you're doing for free. You have to sell a significant number. Of course, your margin is going to be incredible, but also the risk that you take to sell something for a nickel is just hardly, well, in my perspective, it's just never worth it. Some people would say it's rarely worth it. I would go as far as saying never. But in any event, I guess my point is that you really have to determine at what level are you willing to sell. What if this was 10 cents? Would you be willing to do it at 10 cents? To make a living doing this kind of a trade, and it doesn't have to be such out-of-the-money puts, but to sell things like this that have such a low likelihood of the event happening where it could blow up on you, you have to sell a ton of them. To make any money here, what do you have to do? Sell at least 100, right? You want to make $500. Well, that would be a tremendous amount of margin, but more than that, a tremendous amount of risk, because in the unlikely event 99, point something, probably 0.9% of the time, it's not going to make that kind of a move of 26% in a little week and a few days. But when it does happen, that would put somebody out of business. Having a nickel option go to $5 or something like that, if you're short 100 of them, that would be a lesson that you wouldn't forget in a short period of time. Anyway, let's get to my favorite now, and it's number 5. Save the best for last, maybe. That's how I see it anyway. Fill in the number here, 75 to 90. You've probably all heard some percent. 75%, I'll go with that, of options expire worthless. Therefore, you should be a seller and not a buyer. Well, have some very strong opinions on that one. Generally, well, first let me tell you, I found sites that just talk about selling options, and I asked the principals, where did you get the information that 75% of options expire worthless, and why, if that's true, how do you then extrapolate that to you're better off being a seller than a buyer? Well, I've traced it back to a particular, to an article that was done By the way, it's available in a lot of places. I think on Wikipedia. I have a copy of it. I'll show you in a minute, or at least the first two paragraphs of it. But generally, it's based on an article that contains, now again, this is my opinion. I have a lot of support for it, but it is my opinion. A misinterpretation of a study that was done by the CME covering the period 1997 to 1999. The mistake, or the misinterpretation was not, I want to make this very clear, was not done by the CME. It was an article that took data from the CME and was written, and it came to a conclusion that, that you're better off basically being a seller than a buyer. And the study found that approximately 75% of options, and this is the part that's typically, you don't hear this part all the time, that options held to expiration expire worthless. Now, I'm not even going to say this is wrong, that most options that are held to expiration do expire worthless, okay? But that's not the point. From that, right over here, from that, some have extrapolated that it's better to be a seller than a buyer. And let's examine this now in a little bit of detail. First, I want to get some backing for my point of view. This is a quote from the educational director of a major options trading broker. Okay, he runs all the education. I didn't want to say which broker it was right now, but anyway, direct quote: "The most erroneous and yet overquoted notion about options expiration is that 70 to 80% of options expire worthless." I would stop it right there. But he goes, if you ever hear that in a seminar, and if you attend more than one seminar, he said, I guarantee you will hear it, get up and leave. Okay? All right, but I mean, that doesn't prove anything, but that's just coming from somebody who looks at these kind of things. Well, here's some information about this study, or the article really, only looked at options at expiration. Options that were closed prior to expiration weren't included in the study. Right? Now, we know that at expiration, options are worth either zero or parity. And the truth of the matter is, those that are worthless can't be sold. You can't sell options that are worth zero. Okay? So if you have this option, there's nothing that you could do with it. You're kind of stuck with it up until expiration. In other words, if there's a week to go and my option is worthless, I have to hold it to expiration. So these are included within that study, and the point is I can't get out of them. Okay, but anyway, this is the article that I'm referring to. It's from Investopedia. I called him and asked if I could use it, and as long as I have the fact that it is from Investopedia, we're okay with that. The first, it's a longer article, and the article actually was this was in 2009, but a similar article, same author, had come out earlier with exactly the same conclusion. This is just when it appeared in Investopedia. But it looked at the CME and a 3-year period, and it suggests buyers are fighting against the odds. They analyzed 5 different types of options. Okay, but here's the rub. In the very first paragraph, it says, and discovered that 3 out of every 4 options expired worthless. It doesn't have the key fact in here. It mentions it later on that it was those that were held to expiration, making it sound like every option that's opened, 3 out of 4 or 75%, expire worthless. In fact, he's saying 82.6% of put options expired worthless. Okay, but let's examine it. Okay, the options that aren't worthless will be exercised, and the trader ends up with a longer short stock position. Right? We're now at it. We're talking about at expiration. Generally, I mean, you could say I don't want my option exercised, something like that. But generally, most of them will be exercised if they're in the money, unless you tell your broker not to do it. But here's the problem with that: many traders, in fact, most public traders, either you don't have the capital, maybe that's why you're trading options to begin with, or for other reasons, you don't want a stock position. You don't want to hold a stock over the weekend and have a position on Monday morning. You want to be out of it. So what do? You close your option position prior to expiration, and those options weren't included in this study. We're only looking at options at expiration, and at expiration, what's left? All that's left are these. I have it broken down, actually. I'll show you in a second. This is from the OIC, the Options Industry Council. Okay, and they have a series. It's actually very good. If you get a chance to watch it, there's, I think, 25 different myths. Okay, and this is their number one. Selling options is the best way to make money, since they're using 90%. 90% of options expire worthless. I'm telling you, from that one article, you've gotten so many different numbers and so much information that I believe is a misinterpretation. But anyway, they're saying 90% of options expire worthless, when their statistics, now this is from 2008, and I have other numbers. I have numbers from the CBOE. I have numbers from from other sources that have shared them with me on particular equities. But the Options Industry Council, they're saying 12% are exercised, almost, well, 69%. I was going to say almost three-quarters, but 69% are closed prior to expiration, and only 19% expire worthless. So how do we get? Well, let's take a look. How do we get to those numbers? Well, this is, if you look at all the options that get opened, okay, and this is from another source. The ways to close an open options position, whether you open by buying or open by selling, is to cover that option. Meaning, if you sold it, you buy it back. If you bought it, then you have to go out and sell it, right? But you're covering that position. You could exercise it early for any stock options, of course. They're all American style. Or you could exercise at expiration, and the remainder will expire worthless. So if you take a look, this seems to me to say, well, from those that are opened, we have more like, call it 25% or something, some number like that expire worthless. But certainly nothing like 75, 80, 90%, nothing close to that. I mean, I don't think we really know exactly what that number is. For every stock it's a little bit different. For the industry as a whole, every year it's a little bit different. There are lots of different factors, but this is a much closer representation of the options, the percent of options that expire worthless based on the number that are opened, okay? Not the number that are, not the number that are around at expiration, and at the time at options expiration. And it's very telling to me, because so many people have used that statistic and that the article I referred to as proof that you're better off being a seller. And sometimes I talk till I'm blue in the face, and people say, but the article says, and so it's hard to argue with that. But I guess there are some people who do believe that if it appears on the internet, or if it's in a book, then I guess it must be true. So, what kind of conclusions could we draw from this? Well, the one that I draw is that it's not obvious that being a seller is better than being a buyer. It's not saying that being a buyer is better than being a seller. I want to make that very clear. Not advocating either way. So here are the 5 reasons that we talked about. I'm just going to give you some final thoughts. the options decay, time always going in one direction, casinos, sell bets, and they make a lot of money, market makers, the smart guys, or, well, they're not all so smart, but they're considered the smart money. Sellers have to be compensated because the risks are so high. And this last one, which to me is, probably the one that that most people use, most people refer to. So that's my thought. Anyway, here are some final thoughts, and I guess I've made it clear as we've been going along. But the bottom line is that in general, there's no valid reason to be a buyer or a seller. It depends on any particular situation. If you have if your only strategy, let's say, is to be a seller, you say I only want to sell options, I refer to that as a trade orientation. And it's not the only kind of a trade orientation. You could have a trade orientation saying I'm only going to be a buyer. In fact, I had a student who came from the Mercantile Exchange who said, no matter what we do, I don't want to learn any kinds of positions where there could be unlimited risk. Something had gone wrong in his trading, and he decided, he was just going to be, he wasn't going to put on those kinds of positions. He wasn't only going to be a buyer, but he'd do a lot of spreads and things of that nature. Anyway, other examples of what I refer to as a trade orientation would be only doing credit spreads, only doing call calendars, only trading earnings, only doing, and if there's an only, if you say the only way to make money trading options is by doing this, I think I'm going to have a problem with it, because the way I think about things, trade orientations in general are bad. They could work for a period of time. I mean, there was a period of time at our company, McMillan Analysis, we loved doing straddles. And then for a period of time, they didn't work so well. And so what did we do? We changed the strategy. All right? I don't think there's any kind of a trade orientation that will work over a very long period of time. It seems to me the market is too efficient, too complicated for us to figure out some way that we know that that only we know, that nobody else knows, that's going to make us a lot of profits. And so the key is really being able to be flexible and to recognize opportunity when it shows up. So, the way I look at things, there's a time, play on the title here, a time to buy them and a time to sell them, and that knowing the difference is how you're going to make your profits. And that's how I think about these things. Okay, so we just have a couple of minutes left. I just wanted to tell you about our company, McMillan Analysis Corporation. We provide, and probably a lot of you know Larry McMillan. He wrote a book that we call the Bible. I think some other people do as well. Options as a Strategic Investment. But we provide a lot of products and services. We have trade advisories. We have 3 different ones. We do money management for those who want to let somebody else handle the growth of their assets. We do consulting projects to institutions, hedge funds, and individuals. We have a lot of educational materials, CDs and DVDs and books. We have software calculators for several different things. And, my baby is really the one-on-one mentoring that, I run that program, and it's been very successful. Anyway, you could visit our website or call me, Stan Freifeld, for more information. Here's this is my direct number. Most of the time, I'll end up calling you back because, I do a lot of mentoring during the day. We have some specials for people who came to the show, to the webinar tonight. I want to thank you. I know it's around dinner time out in Las Vegas. I was able to eat dinner before. It's 9 o'clock here in New Jersey. So thank you very much for coming by. Hope you found it to be worthwhile. These are specials. They're really only for people who attended tonight. We have our flagship newsletter. I told you we do 3 newsletters. This one's been around. It's in its 21st year. It's 50% off. if you sign up. And I'm not saying you have to sign up tonight, but if you sign up and you attended our seminar, our webinar, it's 50% off. We also have a set of 16 CD-ROMs. It's a home study set, and it's 24 hours of education from novice to intermediate to advanced. I think there's 24 or 25 total hours of education, and it's 60% off. I think the price now is, for the special tonight is $199. That's for 16 CDs. They're CD-ROMs, by the way, which means you watch them and you listen to them. They're not just audio. The Option Strategist, I think it's got 99, or they came up with a half price, so they used exactly, I think it's $97.50. Our office manager made it something like that. And then if you want a copy of tonight's presentation, the slides that I put together, you're welcome to them. They're, I think it's useful information. That's free, and all you have to do is go to our website, Option Strategist. Sometimes people put 2 S's in here. That won't work. It's the word Option Strategist, two words, no space, and .com, and just put /club for the Option Club, and you'll see you'll be able to access the specials that way. Finally, just thanks again for coming, but if anybody's interested in the mentoring, you could click on the mentoring tab at our website, again, www.optionstrategist.com, or for this, feel free to call me directly. Like I said, it's my baby. I love talking about it. I like talking to other option traders as well. Here's my number, 973-362-4558. And yeah, and here's all the contact information, phone number, my email, stan@optionstrategist.com, and here's the information and special deals. Just go, just add club at the end of our website. So thank you very much. Chris is there. I don't know if you're still on. Are you there with me, Chris?
I am still here, Stan.
Yeah. Okay. Well, we're basically done. I don't know if there's anything else that you'd want to say, or is it just good night and we'll wait for the next one?
Well, we'll get to work on planning the next one. I wanted to let everyone know in the chat window I copied and pasted the link to the specials that Stan offered, so it's a little bit more convenient. You don't have to type it out, just click on it. It should work. And some people asked about the slides. You addressed that. A free copy is available using the link that's posted both on the screen and in your chat window.
Terrific.
And let's see. I'm looking at the questions. I answered a number of them. I don't know that this was really on point with the presentation, but someone was asking about pinning risk.
Mm-hmm. Okay.
And whether market makers have a role in pinning the price.
Yeah. Well, I think pinning does happen, but not because the market makers are trying to pin necessarily. Or at least not in any of the crowds that I traded in. What happens is, suppose you have a stock at let's say around $50, and it's trading right around 50 anyway. Pinning risk isn't going to work if this stock was trading at 48, and I'm talking about $5 intervals, and it had to be pulled all the way to 50. Well, let's say this $50 stock is the stock is trading right around 50, and there's an equal number, or a number of puts and a number of calls on either side of the 50 strike. Well, what happens is as the stock price goes up a little bit, people are afraid that their option isn't going to be, their call option isn't going to be worth anything. What do? Well, they go and they want to get rid of it because now it's worth a little bit of money, right? So the market maker, he's the one who's going to, the person who owns it wants to sell it. The market maker is going to buy it. Market makers always go out and hedge their bet, almost all the time. So now I've bought these calls. What do I have to do? I have to sell stock against it. So by me selling stock, I'm going to be bringing the price of that stock down. All right? Then what happens is the stock's moving around. Now it's a little bit under 50 at some point. Well, under 50, now you have the guys who own the puts, the public customers who own the puts. They're going to say, well, I could now get some money for my puts. A minute ago they were, or half an hour ago, they were worthless. Now they're worth a little bit. So they go to sell them. The market maker buys the puts, and now he's, I didn't want to talk about Greeks or anything, but basically the market maker is now in a position where he's got a delta position, and what he's got to do now, he's got to buy stock. He's got a short position. He's got to go out and buy stock. So when he buys stock, now he's bringing the price of the stock back up. And this is kind of happening back and forth, and it's keeping the stock price very close to 50. And that's what happens sometimes, and we refer to that as pin risk. What I normally recommend people to do if they have a position, let's say a position on, and they don't know for sure if the stock is going to be above or below the strike, if it'll be in the money or out of the money, not to wait until the very end. Things are moving around too much at that point, and you don't know if you're going to end up slightly in the money or slightly out of money. Just try and trade out of it. The option that you have probably isn't worth a lot of money, so try and get something for it to the extent you can. We have, we actually have a little bit more of a sophisticated way to close out positions right at expiration, but that would take a little bit more explanation that I can't, I don't think we have enough time to go into right now. But don't wait until the very last minute, I guess, is what I'm saying, when you have positions that are very close to the money.
We got someone asking whether it's prudent to sell weekly options.
That's very interesting. When I was on the floor, we didn't have weekly options, or I guess we had weekly options 12 times a year. That was about it, when the regular monthlies had only a week left of life. A lot of people do that, and in fact, because so many people do it, the volatility of the options that are being sold becomes very low. And the question is, are you receiving enough compensation? There's another train of thought that says there are other types of positions that involve buying weekly options might even make more sense. Again, just like I was talking about with the leaps, and the market makers know what the public is going to do. Public is going to buy leaps, no question about it. Well, generally, the public is going to sell weeklies. So, the market makers aren't, looking to lose money. They're going to lower their bids. So maybe you're not being rewarded properly for selling weekly options. It's not an obvious thing. I mean, trading isn't an obvious thing. There's, again, if that was a trade orientation and somebody said, well, that's the way to make money, you just sell weekly options, I'd say, well, you probably want to examine that strategy because sometimes it'll work, and lots of other times it won't. You have to be a little bit more scientific than just saying this is what I'm just going to sell weekly options.
Ray wanted to know what your mix of selling and buying would be. I don't know if we have time to. I think that might be a little involved, but if you want to comment on that.
Well, I just want to say that. I mean, if you're asking about my own personal trading, and I am, I still consider myself a professional trader. I do almost exclusively spreads. So my buying and selling is, I'd say, pretty close to 50-50. That was an easy one for me because as a spread trader, that's how I think.
Right. And on that same note, someone asked, what's wrong with just selling credit spreads or just trading credit spreads?
Well, yeah. Now that would take a lot of time to discuss. First of all, for every credit spread, there's a corresponding debit spread. So the first thing I would say, if you're only selling credit spreads, you want to compare it to the comparable debit spread. Although if we're talking about option. He's probably talking about out-of-the-money options. So yes, let's say we're doing the credit side as opposed to the debit side because the premiums are smaller. Okay, so that that might be okay, but there's not necessarily an advantage to selling. It depends on how much you're selling it for, and there's no guarantee, or not even, I don't want to go as far as saying a guarantee, but there's not even necessarily an advantage to selling credit spreads. I never really understood that, but you have to understand. I mean, I'm not a fan of iron condors generally either. We recommend some occasionally, but there's got to be a really good reason to put on an iron condor to make $1 and risk 9. We've just seen too many people run into problems with that kind of thinking. They're easy to sell to people. I could convince people to do it if I wanted to, because I could say, here's a trade that's going to win 90% of the time. Say, wow, but if you analyze it a little more mathematically, from my perspective at least, I don't think generally that they're a great trade. I don't want to make any very hard and fast comments, like that right now, because this is a much more involved conversation. I'm just trying to answer in kind of general terms for you. What else?
So Jack's asking, if someone makes money in options, doesn't someone have to lose?
Definitely.
Yeah.
That's what I was saying. It's if we take out the stock, because some people say, well, it's not, everybody could win trading options, but what they mean is, yes, if they're using it as a hedge against, and there's stock involved as well. But if we're just looking at the option side, it's exactly a zero-sum game. Two people are making a contract with each other, and the graph, if you remember, I guess one of the first, the background information I showed, the slides of buying versus selling, they're mirror images of each other flipped around the horizontal axis. So if one guy, if you sell something for $3, the most you could make is $3. The other guy is paying $3, and the characteristics are very different. The guy who's selling, he's got an unlimited potential loss, and the guy buying has an unlimited potential gain. It's just a mirror image with the same number of dollars. If one guy gains 10, the other guy loses 10. If one guy makes 3, the other guy loses 3. So whoever asked that question is exactly right.
Yeah. Stan, the last thing we'll do tonight, I got a message that someone tried to download the slides but received a daily volume alert instead of the slides. So I think what maybe I'll suggest is that they just shoot you an email.
Yeah, they could do that, or I would, what ended up happening, because I wanted, and maybe this is it, I'm not 100% sure, but because I wanted to include information about today's, I wanted to look up SPX, I didn't finish the slides until relatively late in the day, and it might not be until tomorrow morning when our tech guy comes in and uploads this onto the site. So that might be that might be the issue. But if they got a free copy of the DVA, the Daily Volume Alert, I think that's terrific. There's a lot of good information. That's one of our other newsletters. Not the one that I was that I had the special on tonight, but that's a newsletter that comes out every day before the market opens, and there's a lot of good information in that one as well.
Yeah. Well, Stan, I think it's probably past your bedtime.
Yeah. Well, it's 10:15 here in New Jersey, so you're right. I have to get up early tomorrow morning to see what the market's doing. So, Chris, thank you so much. I enjoyed this a lot. I hope you did, and the members of the club did. And hopefully, you'll invite me to come back, and we could do some more webinars. I think
absolutely.
That would be great.
Absolutely.
Thanks a lot, Chris. Thanks for all your help. Have a good night.
Good night, everybody.